Have you ever heard the saying, buy low, sell high in investing? It sounds simple, right? But when the stock market takes a dip and headlines turn gloomy, our natural instinct is often to panic and pull back. What if I told you that these very downturns could be your greatest opportunity to build long-term wealth, especially for new investors? When stocks go down, using a strategy called dollar cost averaging is incredibly beneficial because it allows you to buy more shares for the same amount of money. Instead of trying to time the market, which is nearly impossible even for experts, you consistently invest a fixed sum at regular intervals. This means you automatically purchase fewer shares when prices are high and more shares when prices are low, which is exactly what you want to do. The core mechanism behind this strategy is quite straightforward. Imagine you invest $100 every month into a particular stock or fund. If the price per share drops from $10 to $5, your consistent $100 investment suddenly buys you 20 shares instead of 10. Over time, these lower prices allow you to accumulate a larger number of shares than if you only invested when prices were steadily rising. This fundamentally improves your average purchase price. To put this into practice during a market downturn, the key is consistency and discipline. First, automate your investments by setting up a recurring transfer from your bank account to your investment account for a fixed amount. Second, choose investments that align with your long-term goals, such as broad market index funds or exchange-traded funds or ETFs. These are baskets of many different stocks, which helps diversify your risk. This approach provides a significant advantage by lowering your average cost basis. Your average cost basis is simply the average price you have paid for all your shares over time. By buying more shares when prices are depressed, you effectively reduce this average. This means when the market eventually recovers, which historically it always does, your accumulated shares will likely have a greater overall value. It also removes the emotional guesswork from investing, helping you stick to your plan. Ultimately, dollar cost averaging during a market downturn transforms a period of fear into a strategic advantage. It empowers you to systematically build a larger portfolio of assets at more favorable prices, setting a stronger foundation for your future financial success. By focusing on consistent investment over time, you harness the power of market volatility to your benefit, rather than letting it deter your goals.